Okay, guys, welcome back. Sorry, just the link time elapsed. Okay, so if I'm to continue, we're saying that once it's through profit, through OCI, what they call other comprehensive income, saying this is accounting treatment. Accounting treatment is such that one thing you first look out for is other transaction costs. Transaction. If the transaction costs at this moment in time, we just we capitalize. Okay, in capitalizing, we already talked about it. It's all about adding the cost to the asset. Add the cost to the value of the asset. So for these ones here, they're capitalized. Okay, for transaction costs under this, we capitalize. Okay, if they were through, okay, let me just take this side. So you capitalize, the other side is the opposite. Then the other thing you look out for is the fair value at the start, fair value at the end. You're interested in the change. Eh? Is there a gain or loss? If there's a gain, you go to, actually, I think even if there's a gain, you go to OCI. There's a loss, you apply the IAS 16 bit. There's a loss, you first look, was there a gain on the valuation before? There was, you reduce. There was a gain before. Okay, we reduce. Okay. Until then the balance. The balance on the loss goes to profit or loss. Okay, so this is how we go about it. Now, now back to the question, therefore, the note. The note says that the financial assets represents an investment in equity shares, so those are shares, hence equity instrument. With the company electing to take gains or loss through the other comprehensive income. So through the FV, through OCI, yeah. Then or reserve called equity investment reserve. So this one means that then they're saying that at 31st March, that is fair value at the end, you have it as 65M. Okay, so I'll come here and say my fair value at the end, I will just this working 35, 65M. So what of the fair value at the beginning? At the beginning, you go to the trial balance, okay, and you see if it's there. So not the trial balance, financial asset here, you have it as 60M. So you come and put it here. Okay, as 60M at the start. That's 60M. So is there a gain or a loss? So as you can see, there's a gain. If there's a gain, it's a gain. Value. It is 5,000. I hope you cannot see it. It's 5,000. Okay, the entries for this, you debit the financial asset and credit CI with 5. So we're going to do that. So you come to your other comprehensive income under a P&L. It's P&L here. Then you say gain their value. Okay, it was 5,000. But you know this one here is going to go to what? It's going to what you call an equity reserve or equity revaluation reserve, the way they called it. The specific, I'm not saying it's going to the OCI. Now, like this one here, this one goes to the revaluation surplus reserve. Okay. So by doing this, you have credited. Then you come to your financial assets under statement of financial position. You say financial assets. I've been telling you guys, just bring the new figure, and the new figure is 65. As just like that. The next thing, where is the 20 coming from? 20, I'm not seeing any 20 that I've written anywhere. Where is the 20? This one I was given, we did it already under evaluation. Okay, I already did it. So it's coming from not 1. Okay, so let's continue. Now we have the next note is note 5. Genius estimates that an income tax provision of 6M is required for the year ended 31st March 2021. Okay, that's the new estimate. Then they're saying that the taxation figure in the trial balance represents the under or over provision for the year ended 31st March. Okay, now this is income tax. Income tax, not, I think this is working, it's number 6, saying IAS income tax. Okay. So we say that whenever there's a figure in the trial balance, okay, for now, okay, let me stick to what you guys know. Saying for under provision, saying that the figure, the trial balance, excuse me, let me connect my charge. Here is on credit or debit. So it's a figure on the credit or debit. I'm saying it's on the debit. Okay, that is for actually. I think so. This is a shortcut. To note, if it's an under provision, it's supposed to be a credit. If it's an over provision, it's supposed to be a debit. But this is what I go. This is what I do. That what you do is you look at the figure in the trial balance. If you go there and see the figure in the trial balance, the figure in the trial balance, it's on the debit side, 3,000. Okay, so you come and you say my okay, 3,000, and it is on the debit side. Okay, this is my provision. Tax. Okay, so this is how I go about it. That once it's a debit, the thing is, you just remove the debit by crediting. So credit provision, okay, or tax provision. We know tax provision is same as tax payable. Yeah? Credit tax provision with the 3,000, and you debit income tax or the tax expense with 3,000. Okay, so by doing this, I don't have to know it's an under or over. I don't have to know. What I have to know is it on the debit side? I'm saying yes. So how do I remove it from there? You credit. Okay, so I'm crediting it. The debit entry will have to go in the income tax, the debit, right? This is actually, if it's a debit, then it's an under. Yeah, it's an under. This one is supposed to be like you're seeing, getting the answer after doing. But the idea, that is it. Yes, a little bit. Yes, Chris, thanks. Okay, but as you can see, you can easily see it from here, because once you're increasing your income tax expense, this means that you under provided for it before. You didn't spend much. Okay, so I can easily see it for me, but only write this statement if you know the right thing. If you know the right thing, just come and do what I've been doing. That you're saying my tax in the trial balance is on the credit, so on the debit. How do I remove it? Do the reverse. Credit tax provision, hence you're trying to remove it, and then debit income tax. So that's how we remove it. If it was an over, which I don't want to say, you have to know it's an over provision really. Okay, what we're saying is, as long as this figure here is on the credit side, is on the credit side, saying you remove it by debiting the provision, tax provision. then credit and income tax. Okay, with 3,000. 3,000. Okay. That would be for the over, but let's stick to this. So this is what you do. Okay, debit, credit. Then you go to your the estimate now. The estimate or the new estimate. For the new estimate, it's as simple as recognize the expense because it's an estimate or it's a provision you're making. So we're saying debit income tax with the figure, and then credit the provision or the tax payable, whatever you want to call it. Let's call it tax provision since it has been provision since. Right. So how much was it? In fact, the question again, I got current estimate is 6M. Okay. So we'll say 6 million. This is the current estimate. As you can see, the accounts that are being affected, this is income tax. So this whole thing makes you say that you're going to go under your statement of financial position and you take just the new amount. The new amount is the new estimate. And you say tax payable or tax provision, 6K. Then you go under statement of profit or loss. Just before profit, let me just do it instead of saying it. So saying you come here. Okay, profit before interest. Interest and tax. That one you don't know it yet. Okay. So you don't know it yet. So you bring your interest in case you get to know interest. Then profit before tax. Profit before tax. Okay, you don't know it yet, you will still get it. Now you bring your tax. Tax you're saying this is working number. Wait, income tax. Income tax, this is working number, I don't know whatever it is, probably 7. Okay. But be accurate. Now this is, we're saying we have the 3,000, the debit, then have a new 6,000, giving us 9,000. I can show you how that figure is coming about the 9 in the 6. Then I'm saying then you go under current liabilities. Current liabilities. And you show that you have a tax provision or tax payable. Choice is yours. Tax provision of the new balance, which was 6,000. Okay. Those are the entries that we are doing there. I can just show you what I was just saying. Okay, that you see, what we did is for you to remove the over provision, in this case it was an under provision, we had to debit income tax. So you're increasing income tax because it's an expense. When you debit it, you're increasing it. Then also you had an estimate, still you're debiting income tax. So it is increasing. So you have 3 plus 6. That's why you have the 9. Then for the provision, how it ends up being, the 6 is that you had the balance go down, the one in the trial balance. Okay, you had it as, it was actually a debit. So you had the debit as 3,000. Okay. Remember, this is a liability account. Liability account. So if it's a liability, if you bring a debit, it must be in brackets. Then what happened? You made changes. The changes you had to credit it with 3,000. Now when you credit a liability, it has increased. Say it was an under provision. Okay, that's how the 3,000 comes here, and it's positive because it's a credit. Then the 6M comes from here. Made a new estimate and increased the provision. So the estimate or the new estimate. So let's bring the 6K. Okay, so when you close off or when you balance or when you get the carry down, you're having the 6K balance. That's how we end up having this as the final bar figure. So you don't have to think about this really. That's why again now for you to cram this part comes handy for under. You say for the under, once I have an under, I'm just going to add the new estimate plus what I found there. Then under my current liabilities, I just put the final figure, which is the new one, which is 6. Sorry if it was an over. I've already seen. Pardon the estimate. Did the provision under and the debit. Okay, just repeat what I've just said. For the over, those who are asking for the over, this is what we did. You do the reverse. That here, for under, you're crediting tax provision. For over, you debit tax provision. For under, you're debiting income tax. The income tax is increasing, the expense. For the over, it's going to reduce because you're crediting it. Okay, so what does that mean? It means that for the over, when you go to your profit or loss, income tax, you get the new minus the over, and you close. Then when you go to your liabilities, you just bring the new balance, the new estimate, the estimate alone. That's what you bring. Okay, so I hope I've answered your questions, guys. So allow me continue. So that is tax for you. Then the next line says that on 31st March 2021, which is the year end, Genius issued 50,000 ordinary shares. Okay, when you issue shares, now it still brings us to financial statements. I mean, IFRS 9, financial instrument. We issued shares. Now, for this one, if I go to liabilities, under IFRS 9, here, equity. All along I've been talking about assets. Now about liabilities. Now for liabilities, financial liability, if it is equity, okay, if it is equity, we are saying you do what you already know. Okay, we're saying that you recognize your liability or increases your capital by debiting share capital. Okay, you want to recognize once, what you call initial recognition. You just recognize the investment once at cost, and then after, if there's any dividend that you're paying out or anything like that, you just take it to the P&L and retain the earnings. So otherwise, at share capital, you want to issue it at par. It will be valued at par always. Then you credit share premium in case you had a balance. Okay, then you debit the mode of payment or cash if you receive the money. These are the entries for financial liability under equity instrument. Okay. So you can go and apply this and see how it looks like. So this is the equity thing that we did under intermediate accounting. Genius issued 50,000 ordinary shares for 1,200. 50 for 1,200. Price 1,200. That's the price. But I want to know, is it at par or at premium or at discount? So here I say that for all these shares were paid for through the bank. So made the payment through the bank, not cash. This transaction, however, is not reflected in the trial balance. That's why we're doing it. Then later we made a dividend. So maybe for the dividend, you can go and look at, and there's no transaction cost. You can go and look at the value of each share, each ordinary share. How much is it? So you go to the trial balance and you look through. Now, when you look through, look at capital, equity capital here, it's saying it's at 1,000. Now, this is the par value. So you cannot have equity shares increasing at a more or less value. They must always be at par. So you come here and you say for share capital, it must be at 1,000. So the difference must have been a premium of 200, giving us a total of 1,200. This is bank, not cash. So the shares, of course, remain the same. It is 50, 50, 50 shares. Okay, but how much have you got in total? The amounts. Saying for capital to be this. Then for share premium to be that. Okay. So in the end, your credits must be equal to debits. That's why you're saying credits here. When you add the 50 plus 10, you get the 60. Then you have the 60. Okay, so this is what you're supposed to do. Now, how do you reflect this? Now, as you can see, all these transactions end up in changes in equity, except the bank. Bank was debited by 60. So you come here in your statement of financial position. Okay, to reflect that, let me first even do the equity thing. The saying statement. Like you're saying, you already have these statements in your worksheet. You just go and take whatever belongs there. You go and throw it there. Don't lose those marks. So statement of changes. Equity. So saying have share capital or equity. Then you saw we had that we had something to do with it equity reserve, equity valuation reserve. We also had something to do with the revaluation surplus or reserve. Then you also have share premium. We should go at the end. Then you had share premium. Okay, now for share premium. Now, once you draw something like this, the first thing you do is bring the balances. Okay, balance brought down, or what you call opening balances. The way they are in the trial balance, actually. I respond to someone's chat here. Please tell Kabi that he overcrossed our answers. Okay. But you had your papers and you're supposed to go there and complain to him. You refused to go and complain to him. Someone was remarked and he got 28, yet he was given 14. Okay, so if you have those questions, you have what? Okay, I don't know whether it's going to help you now because I think it has moved on with coursework, but you're supposed to go and complain. That's why they brought back your scripts. So balance brought down. So when we check opening balances, they were given trial balance. You can go and remove and bring all of them. So we begin with share capital. Here, equity shares 1,000 at 127. Okay, 127. I'm not showing you the screen for worksheet, but I will show you later. Then share premium, we had it at 60,000. 60,000. Then what else? Situation. Single valuation reserve here. You have retained earnings. Okay, retained earnings. I'll skip that one. I'm going to put it. The retained earnings. Okay, it was given as 46, 49. Okay, but I will observe that for retained earnings on the debit side, and once you're on the debit side and it's retained earnings, it can only be a loss. Okay, so this is what they had in the trial balance. Can bring it back to the sharing. Okay, This is what we have in the trial balance. Now, you come and bring the transaction here. This transaction they made. Credit share capital. So when you credit share capital, you're saying issue of shares. Issue of shares. When you credit capital, it increases. So you bring 50,000. Share premium still. Credit 50,000. Bring shares instead of 50, then 10. Okay, then the last part is bank. Bank was debited by 60,000. So you go to your trial balance, your balance sheet, statement of financial position, and you look for the bank the trial balance and see what's the opening balance, and then you add that 10. So for the bank, when you go to the trial balance, our bank was on the credit, the 15, showing that it's an overdraft. Okay. But you have received the 60. Now, when you receive 60, it means that now you're coming from a debt to now an asset. So you come here under your current assets. Current assets. Then you say bank. Okay. Then you say 60,000, which you received from issue of shares. Okay. Then minus now the 15, which was the overdraft. So that's how we get the bank balance, new balance. 60,000. 15,000. Okay. So that's how you're supposed to deal with the bank and the issue of shares. Let's continue. After issue of shares, we said inventory on 31st March 2021. Okay, before that, there's continuation on shares. There's a dividend. A dividend of 21 million was declared on 28th March 2021. 28 is still within there. And this transaction has not been recorded or included. So a dividend was declared, so you record the dividend. The dividend, just go to your P&L. At P&L, you got statement of changes in equity. Okay. Okay, in short, you debit dividends and credit dividend payables. Okay, but dividends do not belong anywhere but under retained earnings. So you'll say here, dividends declared. Okay, there were 21,000. It's a debit, so it's a minus. So by doing that, you're debiting. Then you come under your liabilities and credit. I hope this one is okay. I didn't show you the entry, but I've said it in the head. So you come and you say dividend payable because you declared, meaning you haven't paid it yet. 21. So that's how we deal with the dividend. Okay. For those who like entries, what I've said is dividends. Saying you debit retained earnings, credit dividend payable because you've not paid yet. So begin next time I will say dividend paid, then you begin putting dividend payable. If it was paid, you go under cash and reduce. Okay. So you're done with the dividend. Let's continue. Marketing costs. Okay, marketing costs. Then inventory. Inventory on 31st March. Once you see that date, you just look at the reporting date. If they are matching, it becomes closing inventory. Okay, it was 20 million. So they're saying this included inventory costing 5 million, which was found to be defective. So in the 20, there's a 5 defective thing. So you're supposed to go and remove that 5 from 20 and you'll be left with 15. And then they say that the scrap value of this defective inventory is estimated at 4 million and will cost Genius 1 million to sell it. Okay, so meaning that in the scrap or in the defective one, the value of that stock is not actually 5, but rather 4 minus 1, which is 3. So you get the 15 plus 3. That's what I'm saying. closing inventory. Closing inventory valuation. It's saying that you have the balance brought down is 20. You're saying be less because if it's defective, it's spoiled. So you remove it, it is 5. Once you remove it, I will be left with the good one. Good inventory of what? Of 15. This minus that. Okay. So when you bring the value of the defective one, the value of defective, what you can actually obtain, they said it is 4, but you will spend 1 on getting it. So therefore, the value is actually 3. So therefore, our total inventory now will be the 15 plus the 3. So we get 18. Okay, so for the defective, you don't say the higher or the, how will you say it, lower of net realizable value and cost. No, for defective, it is bad. It means you can't use it. So the only option is selling it off. If they're giving you more than what the value was, the better. Just bring up the value. You get. Okay, so the value was supposed to be 18,000. Okay, it's actually 18 million. So closing stock, we all know what we do. You go under cost of sales. You go under cost of sales. Here you say less. Okay, say under cost of sales, not this one. Is my cost of sales. My workings here. Under cost of sales, you bring here and you say closing stock or inventory. This is minus. Okay. Minus. Then you come under your current assets and you bring inventory. You bring the closing, which is 18. So that's how we deal with the closing inventory. Then hopefully the last part. They're saying that marketing costs, salaries, telephone expenses amounting to 6 million, 8 million, and 4 million, respectively, were prepaid as at 31st March 2021. And they're saying that all these costs relate to distribution costs. So prepayment, here you just add and just end up with the final answer. That is 6 plus 8 plus 4, that will be 18. So an 18 is a prepayment. If it's a prepayment, you're saying the entries are. Let me first show you the entries for prepayment. Okay, once you prepaid, and these are expenses, remember. So if the expenses are prepaid, you all know to have what? An asset. So you debit prepaid expenses, those assets, and then you credit the expenses themselves. But in this case, the expenses themselves, we're saying they're under distribution. Okay. If you have time, you'll split and just have electricity, what. But for now, let me just do this. It is 18 in total when you add them together. So you come under your current assets. Okay, you say prepaid expenses and put 18,000. Then you go to your distribution costs. Distribution. Okay, and our schedule, you say your distribution, you say prepaid expenses. If you had split, you would put your electricity, insurance, whatever they had put. But here it was 1. So it is 18,000 and it's in brackets. And the reason is because you're crediting it here. Okay. When you credit an expense, it must be subtracted. So officially you're done with additional information. Any questions on additional information before we summarize? Before we finish everything. So if there are no questions, we can now go to the final part, which is going to the trial balance. Then you move line by line, checking out if there's anything that you left out, you include. Okay, so of course, we shall go to line by line, Eh? How do you treat retained earning loss? You already put it in your, you go under changes in equity. Changes in equity. Okay, here, changes in equity, statement changes in equity. Under retained earnings, you bring it as a negative, it's a loss. You bring it as a negative. If it was a profit, it is positive. Remy, I hope I've answered you on that for the loss. So that's why it's here as a negative. Okay, so let's continue with what I was saying. So we're saying that you come and you move line by line.